Good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in the market. This is our last call of 2021, and I want to thank all of you for joining these. We know we have some regular clients who call in every other week when we do these. So we thank you for your time, and we try to keep these interesting. So if there's anything that we should be talking about that we're not, give us an email, shoot us an IB, let us know what's on your mind. We're happy to take requests, I suppose. So with that, I want to wish everyone a holiday, and here's our last 30 minutes of views on the market before everyone takes a little bit of a break for the year end. And so one of the products that we feature regularly as part of our research at BI is asking you what you think about the market. So we conduct client surveys every 3 to 6 months, typically ahead of an OPEC meeting, and then we share the results back with you to let you know what everyone else is thinking. So I think they're a quite fun product. Our senior analyst, Salih Yilmaz, is the one who shepherds that through the process. And so, Salih, with the most recent set of survey results, I want to come to you and get your view. You know, what are expectations for oil price, the Brent oil price, as you look into 2022? Give us a rundown.
Sure. Thanks, Rob, and hello to everyone. I hope everybody is doing well ahead of the holiday season. And yeah, I mean, I can go through some of the results that we got from this survey. As you said, I think these surveys are a great product, and we really get some very interesting results every time. And some of the questions we always ask, and that really helps us kind of get an idea of how the sentiment might be changing on some of these questions. And as you said, on the oil price, I mean, this is something that we always ask. And when we asked this time around about where people think oil price will be at the end of next year, I must say it's generally bullish views abound. About 82% of the 122 respondents to the survey think Brent will be above $70 a barrel at the end of next year. And I mean, currently Brent this morning is sitting at about $73 a barrel. But more interestingly, perhaps, about a third of the respondents think that the Brent price might actually be above $90 a barrel. And I think generally this is in line with at least kind of range bound above $70 and perhaps about $80 a barrel is in line with kind of our outlook for next year as we look at kind of demand being resilient beyond the Omicron variant uncertainty and perhaps weakness. We do see OPEC continuing to bring more supply, which will bring spare capacity down. We will still kind of have inventories that are most likely below 5-year average, and we will probably be sitting at a point with less strategic reserves. So I think all combined, we're looking at a constructive scenario for oil prices next year. We had a couple of other questions as well. I mean, very quickly, we do ask about OPEC and whether people think they will still be around, especially the OPEC Plus alliance, which is OPEC plus some other allies. And 71% think that the OPEC Plus alliance, as it stands right now, will still be in place in 2025. And this is pretty much the same. I mean, we did have majority thinking the same in the last few surveys where we asked the same question. About 60% think oil demand will be above pre-pandemic level next year, and over 70% see oil demand peaking by 2035. And I don't want to make this answer much longer than it already is, but I am happy to talk about how, because I think in terms of sentiment, this is a really interesting one on how what people think around when oil demand might peak has really changed when we look at how the results to this question changed over the last couple of years. But when we asked this time around, very few people thought that it will peak before 2025. While when we asked the same question last year, a lot more people thought that it might actually peak by 2025 or by 2030. So it was very interesting to see clearly the oil price, I think where the oil price is and what the outlook for oil prices are, is a very kind of interesting and big driver for how people approach and answer this question. And couple
Hey,
of
Sally, I want to come back to more parts of the question, and I think the demand piece of the survey is one we can spend some time really unpacking. But before we really unpack all of the results, I want to bring on Will and get him to share his views on the fundamentals. Salih just painted a relatively constructive and robust oil price outlook that's stemming from the survey. Do you see it the same way from the fundamentals perspective? And if the oil price is going to remain elevated, what's it mean for all the companies on the upstream side? Are high prices already baked into expectations, or is there is consensus maybe discounting where the oil price is at? So, how do you read it into the fundamentals of companies as well?
Yeah, thanks, Rob. So I think firstly on your first point, we continue to see bullish fundamentals for oil next year, barring a significant impact from the Omicron variant, which we are not currently seeing. Oil demand is going to hit a record next year at over 102 million barrels a day. This is above pre-pandemic levels. We continue to see very strong supply intervention by OPEC plus. Weak non-OPEC supply additions. We to see U.S. Permian players struggle to add rigs and instead favoring shareholder distributions in the form of buybacks and dividends. So we think this supply scenario and climbing demand to at or above pre-pandemic levels certainly paints a pretty rosy picture for oil prices next year. And clearly to your second point, there are many companies in the energy spectrum that are set to benefit from this, we think. And right at the top of that list is the European independent E&P space. I think it's important to frame this with their performance throughout the downturn, which has been downright terrible. They have been among the worst performers throughout the COVID-19 pandemic, but with improving free cash flow yields and a very high exposure to prevailing oil prices, easing hedge books, and balance sheet debt coming down quite nicely. These companies are right at the top of the list for companies that for investors to gain exposure to the underlying commodities. I think an important element here is that while these companies are very interesting from a commodity linked performance standpoint, there are longer term risks. Particularly in the UK North Sea. We see limited growth visibility given the North Sea basin is mature and overall declining in production, and this carries into higher unit costs. We're also see higher than average emissions intensity, and obviously climate and sustainability risk are at the front of many investors' minds. And so we would just caution in the long term that this sector is uniquely exposed, we think, to climate and sustainability risk. But then, of course, in the short term is also highly geared to commodity price upside.
Very interesting framing, Will. I want to tie it back to one of the survey questions we asked. So one of the questions we looked at in our most recent survey is, when will EU oil majors hit 50% of total capex being allocated towards green projects, energy transition projects? And I want to hear your thoughts on the survey result, but I also am curious because there is a narrative in the sort of broader oil landscape right now that one of the things that's caused the current price strength is underinvestment because of the pandemic, and perhaps also because of increasing focus on clean energy, energy transition type capex. So, two questions there. When are EU oil majors going to approach 50% capex, and what is there any kind of validity to this near-term argument that the industry sort of lost focus and doing too much green in the near term?
Yeah, so to the first question, the results from our survey actually quite surprised me, in that a plurality of our respondents thought that that EU oil major energy transition or green capex will comprise more than half of their total spending after 2030. And this surprised me because it actually sort of contrasts with what several companies have said already, that Total and Equinor have actually said that they expect to be around half of their capex to be green or transition oriented by 2030. And especially given the accelerating pace of this share of spending. I mean, just a few years ago, the level of green capex being spent among this group was nominal. It was so small that it wasn't even broken out or announced by management. And now it's actually this year beat our expectations for the amount. The group is at roughly 12% or so of total spending this year into green or transition areas, and we expect this to continue growing. And to the second part of your question, there is a valid argument here in our view that upstream underinvestment has contributed to the current scenario in global oil markets. But it's not just because of COVID-19 pandemic. There's an argument that the European oil majors and oil majors in general have been underinvesting since the 2014-2015 oil downturn. This trend is more emphasized among the European majors. This is in part due to elevated investor pressure on ESG and sustainability matters. The European majors are far more advanced on their emission strategies, on their energy transition strategies, whereas the U.S. majors continue to focus and double down on U.S. shale and deep water oil. So yes, I think this is a valid point to bring up. But with that said, I don't think this trend is really going to change. There's several management teams have come out and said they are not going to adjust their segmented spending if oil reaches 100. They are continuing with their energy transition plans and strategies as they've been laid out, which shows to us that this scenario could extend and really plays into this non-OPEC weak supply growth that we see in the coming years.
Very interesting. Okay, so I want to flip back to Salih. Okay, you've just heard Will's comments and on green spending, and part of your coverage portfolio, Salih, includes a Saudi Aramco, includes some of the sort of tier 2 integrated oil companies in Europe, like an OMV. Are they thinking about this issue from the same perspective? How does their capex compare to what Will was just talking about, how he's seeing things shift from the EU oil major perspective, the BP, Shells, Equinors of this world? So give us a little contrast.
Sure. I think I'll start with Aramco because that's really the main contrast. I mean, when we look at some of the other mid-size integrateds that I cover, I would really put them in the same bucket as some of the larger majors because we are really seeing similar pressure on them, and we're really seeing similar steps taken in terms of coming up with more emissions targets, kind of telling us what they're going to be doing about the energy transition, etc. Aramco, on the other hand, is a different story because obviously, I mean, they are responsible for the totality of the Saudi Arabian production. And obviously, as part of OPEC as well, their demand outlook may be perhaps a little bit different to what others are seeing. I mean, they do see oil demand being very strong beyond just the near term, beyond just the next few years. And they think the call on OPEC, and Saudi Arabia is the biggest oil producer within OPEC. They do think the call on OPEC, how much the world needs OPEC to produce crude, will be going up. And they think that they have the responsibility, and they also kind of see this opportunity for themselves to invest more, to actually increase their capital spending into legacy oil and gas production, because they think there will be room for them to be producing. I mean, currently their maximum capacity is at about 12 million barrels per day. Currently they're producing about 10 million barrels per day. But they seem set to spend billions of dollars to increase that maximum capacity to 13 million barrels a day, which they think they will be utilized later this decade. So I think as an NOC and as the biggest part of OPEC, I think they have a slightly different opinion on how much they'll be producing towards 2030.
Okay, so that's pretty interesting, and a sort of a distinct view on the market that's a little different from some of the perspective that we've heard from our clients and just looking at the thinking within EU oil majors. So you already mentioned that this idea about peak oil demand. We generally ask this question as part of our survey. And we've seen it kind of bouncing around, right? You know, that as you already noted, the last time we asked the survey was about peak oil demand. We were kind of at the depths of the pandemic, and people had very different views. They were much more concerned that it was happening in the near term. Those expectations have shifted out a tad. But okay, so I want to frame, because I was just reading the news the other day, and I saw that Toyota is now making a really big push into electric vehicles. They had been one of the automakers that have been dragging their feet. They were very much geared towards thinking about hydrogen and fuel cell vehicles, but I think they've sort of shifted their strategy and made a big announcement about it this week. So, you know, when you read the tea leaves, it seems that the pricing scenario and the short-term demand scenario is pretty constructive, pretty strong. But as you go out in time, things get a bit more wobbly, particularly when you look at demand, I think. So when do EVs really matter for thinking about the oil market? Is it time to be paying attention? Or is it so small still that you can kind of ignore it? I'll let you go first, Salih, but I want to get your thoughts too, Will.
Sure. I mean, I think it's already been time to pay attention to it for a while now, and I think Toyota is a really good example. I think for them, the hybrid Prius has been a huge success, and this was kind of their focus. And as you said, I think they did talk about fuel cells quite a lot, but it seems now, following up the news from a couple of days ago, it seems that they are starting to invest much more heavily into EVs, which really seem to be the direction that we're going in. And I mean, just before I joined the call, I was reading a tweet from our colleague at Bloomberg NEF, Nat Bullard, who says about 20% of car sales in November in China were EVs, full EVs. I mean, these are staggering numbers. And we've always talked about how EVs, along with increased fuel efficiencies, will be a problem for oil demand. But I think this was really being dismissed as a long-term problem, which perhaps it was. But really, I mean, seeing some of these numbers, not just, I mean, we were talking about Norway, which arguably is a small place, But I mean, seeing these numbers from China and some of the much bigger countries, it is just crazy. And I think we knew this long-term challenge for oil demand was there, but I feel like it's really becoming time to pay a lot more attention to it. And again, I agree with you that in the next couple of years, I mean, especially looking ahead for 2022, perhaps we don't quite see that impact just yet, even though adoption is accelerating at an impressive rate, and perhaps the year after that as well. But really, I mean, when we look at the middle of the decade, I think we really will see this acceleration in adoption in EVs. And perhaps, I mean, fuel efficiencies, you could argue, have trailed expectations, but I really do believe that this will catch up as well. So when we look at the middle of the decade, I think we really will start to see the road transport part of the oil demand really starting to struggle from some of these challenges that we've been talking about for a while now.
Will, I want to come to you, and I want you to frame maybe how you're thinking about it. One of the classic narratives here in the oil market is, oh, well, sure, we see Norway and Germany and the UK really having some impressive EV sales numbers. Oh, and then it flips and you sort of say, okay, China is now in that bucket as well. But the holdout would be, well, how's India going to develop? What's going to happen there? What's going to happen in Africa? How does that really feed into sort of your medium-term oil demand expectations? And what are the companies you cover thinking on this front?
Yeah, so I think just firstly, I'm going to be slightly contrarian here. I think that it's important to know the current state of the oil of the car market, right? So there's over 1 billion cars in the global fleet right now. Nearly all of them are internal combustion engine cars, right? The vast majority of new car sales right now are still internal combustion engine cars and will be for many years, right? Despite a very quickly accelerating EV adoption pace, right? I think we just saw over 20% of new car sales in China were EV in November. We're seeing higher levels across Europe, and the US is still far behind. The average life of a new vehicle is roughly 12 years. So I think these are really important elements here, which I think sort of blunt, some of the calls that EVs are going to be a major driver of oil demand, dropping like a rock within the next decade. Keep in mind that light vehicle transport oil demand is roughly a quarter of total oil demand, right? So I think these factors will help, smooth out the decline of this quarter of oil demand that comes from the segment. There's no doubt that EVs are growing very quickly, and that by 2030 there'll be likely more than half of new car sales globally, but still there's still resilient demand from just the sheer volume of internal combustion engines globally right now, over 1 billion. And as far as medium-term oil outlook, this has definitely pulled forward. I think we've been polling our clients on this for some time, and it's just steadily become closer and closer and closer. I can remember years ago when the plurality of our respondents were calling for peak oil demand post 2040. I think you will not find anyone credible at all with that kind of call right now. The general consensus among oil majors is before the end of this decade, and I certainly would agree with them on that.
Very interesting, and I think you framed it well, right? If you think visually of how it unfolds, there's probably no cliff in sight, right? So it's more of sort of peak, but then it could be undulating or kind of holding steady. I think the idea that it's just gonna, if you look at some of the IEA scenarios or the IPCC, where they show some of the climate things that might need to happen under certain scenarios, and they just show these just rapidly falling outlooks. I don't think we're anywhere close to that. But could it be the sort of peak and then sort of a sort of gentle glide? Yeah, that seems to be the thing that's potentially in sight. Let's see. Everyone's got their own crystal ball. We've got a couple of questions that you've asked folks who are listening. So we'll maybe turn to those now and see if we can answer those with the few minutes we've got remaining. So one of them relates to OPEC Plus. And so I think this question's for Salih, but could you share your views on how OPEC Plus will manage supply in 2022? And and depending on their action, where's that going to put the supply demand balance for the global oil market?
Sure. So, I mean, most agencies and our scenario analysis suggests that the market is flipping into a surplus next year, and that's because of just a slowdown in revival in demand and higher non-OPEC supply. And even OPEC's own analysts are expecting a surplus to be there for at least the first quarter and perhaps for the second quarter. But that being said, we know from the last OPEC meeting that they've kind of ratified that they will continue to increase their output in line with the initial plan of 400,000 barrels per day in January. But when we really look at the expectations for the oil market from all the agencies, including OPEC, I think it's fair to assume that if we really do get this surplus that everyone is expecting, I think it's fair to assume that when they meet on the next meeting is on January 4th, I think they will probably be expected to at least consider pausing these output hikes for a month or 2 or 3 at some point next year, depending on how demand plays out, depending on how much the Omicron variant really impacts oil demand, and how much non-OPEC supply growth we see from outside of OPEC. So for now, we know they're expected to bring the 400,000 barrels per day in January, but from there onwards, we are expecting them to pause at some point. But by the way, I mean, I should say we are kind of looking at how much they're actually bringing back into the market, and that's not always the 400,000 that they're promising to the market, because we know that there are especially some African member nations such as Algeria, Nigeria, and Nigeria has done okay in the last month, but in the previous few months, we saw them struggle to bring back their output levels to the target levels. So, but everything going according to plan, I think it would make a lot of sense that they pause these output hikes at some point. But you know, these monthly meetings are still in place. They're obviously monitoring these very closely. I mean, when you look at the last meeting, I mean, I thought it was a pretty smart move to keep the. I mean, they've decided that they will add 400,000 barrels per day in January, but they kept the meeting in session technically. So like the meeting hasn't ended. So they could, I mean, if there was a huge price reaction to the downside, they could kind of step in and change that strategy. So, and that seems to have worked pretty well for them, because I think that's really essentially put a floor on the price for them. But yeah, I mean, this is, again, it's very difficult to tell where they will be in the summer. They are looking at this month by month, and we are pretty much looking at this month by month. So we'll see what happens in January.
Fantastic, Salih. Thank you. Okay, one more question. These calls always go so fast, but we had a question on the gas market, and Patricio Alvarez wasn't able to join us today. He covers the European utilities and the gas situation in Europe. But Will, I think it ties into some of your coverage in the North Sea, and so I know you're following it very closely. We're essentially still touching record gas prices in Europe, record power prices in Europe. What does this mean for the LNG supply-demand balance, and how are the European upstream companies positioning around what's happening on the gas front?
Yeah, so just quickly on LNG, our outlook for LNG next year remains quite positive as well, just like in oil. This will be led by resilient and relatively high Asian industrial demand. Of course, China comprising a big component of that. And of course, as you mentioned, given the European energy crisis ongoing right now, we expect European importers seeking to refill low inventory, so they'll be bidding up for LNG cargoes here in Europe. And so given this, we think the market should stay pretty tight, keeping prices high and fueling netbacks. This could temper demand a little bit, but we still think the LNG trade could rise 5% next year. I think it's important to note here that this really underscores LNG's role in the energy transition. Of course, there's a lot of pushback against fossil fuels, but LNG and gas is a key driver here. Obviously for power and heating, particularly when we're seeing increasing coal closures and some countries bringing forward their ending coal-fired power gen targets. And so we continue to see a strong outlook here for LNG and particularly into mid-decade as well, where we see the possibility of being in an undersupplied market, which of course partly reflects that upstream underinvestment theme that we talked about earlier, and just a scenario right now. European gas storage is at about 62% right now. This is very low. This is 17% below the 5-year average for this time of year. We typically see this level, the 62% level, hit in mid-January. So we are running, more than a month ahead of where storage typically is, and this is driving increasing sort of mania in the front month gas markets. We've seen Dutch TTF and the UK National Balancing Point benchmarks reach record highs in recent days, and it's not just front month. We're seeing this sort of spill over into next year as there's increasing concern about ability to refill inventories throughout the refill season in the summer, and of course this bodes well for the LNG exporters as well.
Thank you, Will. We're going to have to make that our last comment of the day. Again, I want to thank everyone for joining our call and for all the calls you've joined throughout the year. We know this is a substantial commitment of your time. Hopefully it's useful for your purposes. Everything we talked about is contained and embedded on BI Go. So you can find the survey. You can find our 2022 outlooks for any industry. So you can find the outlook for European refiners, European E&Ps, integrated oil companies, the solar industry, if that's your thing. So all on BI Go. And give us a shout if you have questions on anything that we're putting out. We want to engage with you. We hope you find them useful. And we look forward to talking to you again in 2022. We're going to skip the first Wednesday in January, but we'll be back onto our normal schedule of the first and third Wednesday of each month starting next year. Have a great holiday, everyone, and we'll talk to you soon.
Thanks, everyone.
Thanks, everyone. Cheers.